So thank you, team, and congratulations on getting so far. I have a question which actually you started to address right at the very end. The company's capital structure seems rather conservative. Maybe you could comment on that.
Okay. Well, we must remember that this is a new company and it's only been in operation for the last few years. And as I said, the company have been consistently writing down their debt levels for the last few years, and as can be seen, the benefits are now being seen by shareholders. From our discussions with the company, we found out that the ability is there for them to increase their debt facilities in the coming year if it is so required. So therefore we feel, and as the integration benefits are something that they are very focused on, we feel that this will come in the next few years, increasing the returns to shareholders, and we feel that the capital structure is ideally suited for them going forward in terms of realising the benefits that we mentioned.
And just to expand on what Dahi said there, yes, the capital structure has been quite dynamic in recent years, but in a very turbulent market, Origin has consistently written down their debt, with something which in an Irish market alone is very difficult to do, let alone every other market, I'm sure you are aware. So therefore, the fact that they've been returning shareholder value in the form of dividends year on year while paying down this debt, keeping an open access to further debt, means that they have the possibility to keep the growth and acquisitions of the company going.
You mentioned Eastern Europe as a medium to long-term growth opportunity. To what extent is the company Origin already operating there, and to what extent can the business model be translated or be applied in Eastern Europe? It seems to me that they rely on agronomists, and maybe the relation they have with farmers in the UK or in Ireland may not be so easily translated or applied in Eastern Europe, given the different structure of farming there.
Well, Origin currently operates the model very successfully in the UK, and in Poland they currently also operate the model with a 10% market share there. So, and they're also looking to move into Ukraine, where they have a direct farming business, Continental Farmers, which I mentioned earlier. But Poland specifically has very low yields, half that of the UK, of 3.5 tonnes per hectare, whereas the UK is 7 tonnes per hectare. We believe that the model can be transferred to Poland, and the way they will do this is they will acquire businesses in Poland, distribution businesses, and then they will bring their technical knowledge to those distribution businesses to add value and create value for shareholders. And that's the way they will penetrate the market there. We believe that is possible because the sector is consolidating in Poland and it's becoming much more commercial, so they will be open to new agronomy services.
You talked quite a lot about your discounted cash flow model and sort of comparative valuations. I don't have much of a sense of the absolute valuation. How is this company actually valued today?
As in, if I understand you correctly, where is the actual value in the company as it stands, is it?
No, sorry, that wasn't my question. My question was about what valuation metrics do you think are appropriate for this company? What sort of dividend yield has it got? Price to sales, price earnings? I mean, you talked very much about the discounted cash flow rather than any sort of absolute valuation measures other than discounted cash flow.
Sure. I might just draw your attention to our relative valuation model, if I may, please. I suppose this company, Origin, is quite unique in that it's very hard to find a business operating to the same scale of it in terms of agronomy. And obviously we wanted to validate our DCF, so we approached it in the following fashion. In terms of our relative valuation, we looked at the Irish market, where Origin is based and where its businesses have been consistent. And we looked at the two main players in the Irish market, mainly Kerry Group and Glanbia. Origin, both from the IAWS days and presently, has supplied these companies with agri-inputs, and these are two of the main, they're very dominant in the Irish agricultural sector. So we use these as our comparable companies. The fact that the PEs of these companies trade above Origin is down to the fact that the market would not view Origin as a similar size business, because the intellectual capital that they possess would not be valued in this. Like Kerry and Glanbia Group are both agri-inputs denominated companies. And I suppose coming from those, we got share prices of, we multiplied we used the PE metrics and the PV or the PE metrics and the PB for both, to come up with share prices, and we worked a share price of 475, which validates our DCF. Secondly, in relation to this, we looked at the Origin business as a whole and broke it up into a number of segments. We focused on the agri-nutrition side of the business and the associates, and we picked a number of industry companies that supply parts of Origin, and if I could just show you a list here. Yeah, we broke agri-nutrition into 3 specific sections, mainly crop protection, fertilisers, agri-feeds. And we looked in the associates, we picked companies which matched the scale of Origin's associates. And coming from this, we looked at the weight of profit that each of those attributes to Origin, and we got an average of each, and we came up with PE and BB for industry competitors, and we were able to multiply the earnings by that. And again, we got share prices lying above the current line, and I suppose that in turn helps us to feel confident about our DCF.
Thank you very much.
Perhaps you could say a little bit more about the risk side. I know you ran out of time, but I think you gave a sort of a judgment around 4 risks, and it would be interesting to hear it slightly more as a sort of set of scenarios, a probability and an impact. And is that set of 4 risks, what would be next on the list? Where would you see other risks biting?
Well, I suppose there'd be risk coming from Origin's growth strategy, particularly in Ukraine and Poland. Origin has a track record, and a very shrewd track record, of M&A acquisitions. However, in Poland and Ukraine, there's a lot of small family-based businesses and also some state-owned companies, and we feel this could be difficult for Origin to penetrate and capture those companies. I suppose in relation to the other risks, the main one we see as important is the ownership structure. Arista maintains a 71% stake in Origin. We feel that ultimately this can be I suppose written off against the fact that eventually Origin will be sold by Arista and the shareholders will receive a risk premium and a premium, so we'd be confident that ultimately this will be negated.
Could you expand a bit on competitors to Origin?
Many of Origin's competitors are in the UK, and there are a list of competitors which we can actually bring up here. And most of them are not publicly traded like Origin. And what Origin has unique in their agronomy business is research and development, number 1. None of these companies can offer the same level of research and development as Origin can, which brings farmers to Origin. And also, secondly, Origin can offer a full suite of products to farmers, unlike these competitors, from everything they need from seed to fertiliser, and they'll tell them exactly how much they need to sow, when they need to sow it, and that will increase their yield. So that brings all the farmers to come to Origin first. So it's the first port of call, and it's essentially a one-stop shop for the farmer where they can get everything, all the advice and all the inputs they need, which differentiates them from their competitors.
I think to back up Rob's point, Origin's agronomists are able to use their direct interface and relationship with farmers to further sell the agri-inputs, whereas none of the other companies outlined actually back up the farmer with selling the agri-inputs. And we see this as this intellectual capital, and being able to back up this is crucial to Origin going forward and what differentiates them from their competitors.
A trivial point, really. You have a risk-free rate of 2.98. Why didn't you round it off?
Accuracy. We wanted to build in as much. The 298 we reflective was where Origin's core market is in the UK at the moment. We considered using the German risk-free rate, but due to the flight to quality that's currently within the market, due to the equity, the worry around the equity market, we felt that the UK rate should be more reflective of market sentiment towards Origin.
And you might just be able to amplify on the other 2 figures there, the low beta 6.69 and the high equity risk premium.
The base was calculated by completing a regression from Origin's historical share price against the AIM index results over the last 2009, I think, to 2011. The equity risk premium then, we calculated that the current historic rate is 5.5. However, due to the fact highlighted earlier of the liquidity, the lack of liquidity in the share price, we felt that this needed to be increased to reflect this lack of liquidity that's available with the 71 Arista shareholding that currently exists. However, the current the current European reaction towards equity risk at the moment is 11.1, but we've also felt that with a low beta of 0.69, the current market sentiment towards equity stocks isn't as applicable, as the systematic risk within the company isn't as high as it is there. Oh, thank you.
Very nice.